Hi, everyone. Good morning, good afternoon, good evening. My name is Isaiah. Welcome to my first episode of my Monday market commentary for the new year for 2021. In these videos, in these podcast episodes, we're going to talk about the markets. We're going to get a little more technical in that area. We're going to talk about that. We're going to talk about investments. We're going to talk about the economy. The point of these types of videos and podcasts is just to educate you further. Again, there's a lot of information out there when it comes to investments, when it comes to the markets. And I feel it's my job to simplify all that for you into layman's terms so that you can understand it and so that you can absorb it and use it for your own knowledge. And so in today's episode, I'm going to share my computer screen with you here shortly and just provide some perspective on things that happen in the markets, good things, bad things, but I think it's important to share it with you because as investors, as retirees, as pre-retirees, I do feel that it's important to know this information so that when these occurrences continue to happen, maybe this year or in the years ahead, you know what to expect and you know what history has told us from these events. So I hope you enjoy my 2021 market outlook. Please enjoy. All right, everyone. So we're going to start here. Actually, I'm getting ahead of myself here. The beginning of this is from First Trust Portfolio. So I'm sharing with you a slide or a slide deck from First Trust Portfolios. They're one of the largest ETF providers out there available. For those of you that are watching that are my clients or those of you that are listening, First Trust is one of the partners that we use when it comes to research, when it comes to help us just provide some more knowledge to see, hey, what are the markets telling us? What's the economy telling us? And helping us lead you, our clients, into the right direction. And so from time to time, they do share some very good files and documents with us. And this is one of them. This is what they call a client resource kit, markets in perspective. So it's just a few slides that provide some perspective on the markets, exactly what the title says. And so let me start with the first page here. For those of you that can see this, I'll give you a moment to take a look at it. For those of you that are listening on the podcast, let me describe to you what this slide is saying and what it is. This slide is the S&P 500 index, the returns from 2008 to 2020. So it gives you a chart. So visualize a chart if you're listening to this and the ups and downs. If you look at it, it starts from 2008, ends in 2020. Overall, the market, the trend of this chart moves higher. Yes, throughout the years, you see some ups and downs in there. But when you look at this chart from 2008 to 2020, it's a nice 45-degree angle. It's gone higher. And then in between all those years, there's little lines sharing with you significant events that happened during those times. And so I'll just read a few of them. The first one I see is Lehman Brothers files for bankruptcy. The Congress passes TARP, which is the Troubled Asset Relief Program. $787 billion in stimulus bill assigned, and this is during the 2008 crisis. In the middle of this, I see that there was Hurricane Sandy that hit New Jersey. That's in 2012. The U.S. budget sequestration takes effect in 2012. We also see oil prices collapse begins. That was in 2014. Paris terrorist attacks in 2015. We see Hurricane Harvey and Irma in 2017. We see all kinds of things that the Fed announces, rate hikes, balance sheets, all kinds of stuff, tariffs. And then in 2020, we see the coronavirus. We see all the things that have happened. The first confirmed cases of coronavirus. The FDA approves their vaccines. Fed cuts rates down to 100 basis points, all kinds of events that's happened. And for the most part, if you take a look at all this, most of it probably isn't the best news if you take a look at this. I don't think hurricanes are the best, or stock market crashes, or debt crises, or bankruptcies. But what it's trying to tell us is that even throughout the years, and really even throughout the past decade, there's been some events every single year that looks as if they're not going to be positives for the stock market. In fact, they're probably going to be negatives for the stock market. But what has happened through all of that? When we look from 2008 and we look all the way to 2020, First Trust gives us an example. In 2008, If we invested $10,000 and we just left it alone, we didn't do anything, we went through all the ups and downs of the S&P 500 market, that $10,000 in 2020 became $33,645 with an average annual total return of 9.78%. So simply put, things will happen and things will continue to happen in the stock markets. But don't let that discourage you from staying invested in the markets, because even with all this happening, that $10,000 tripled in value. Not saying it's going to continue to happen that way, but it's just a nice visualization to share with you, hey, you know what? Even through bad times, markets continue to rally. Markets continue to move forward for investors. And so let that be important to you. For those of you who are my clients as investors and who have those retirement accounts, know that these events are going to happen throughout a given period of time. So every single year, something will happen. We already saw one this year. The Capitol was stormed here last week or the week before. The events will happen, but markets, history has shown us that they will continue to move higher. So please, as investors, pay attention to that and make a note. The second one I want to share with you is exactly what First Trust says. The second page says, staying the course. You know, we always think about this, and let me visualize this for you. And let's remember, last year in March and in April, when the market was crashing here, market went down by 34% at one point. I had clients call me up saying, hey, Isaiah, should we be invested? Should we stay invested? What should we be doing? Here's what I want to share with you is the intra-year declines versus calendar year returns. It's a visual that shares with you everything that's happened. Hey, markets have been down on average in the last 10 years, from 2010 onwards. Every single year, market was down. The worst it was down, it was negative 16%, negative 19, negative 10, negative 6, negative 7, negative 12, negative 11, negative 3, negative 20, negative 7, and then this past year, negative 34%. That's the worst the market went down in that given year. But in those years, here's what the returns were: 13%. And this is where the returns ended the year. So the market was either up or down in these given years. And starting from 2010, 13%, 0%, 13, 30, 11, negative 1, 10, 19, negative 6, 29, 16%. So it shares with you that, hey, you know, markets, we're going to see a market downturn pretty much every single year. But odds are is that the market will end up positive. Yes, there's a few negative years in there that I mentioned, but overall, it's important to show that, hey, staying the course rewards you. Being patient rewards you. It's important to pay attention to that, again, as investors. The third one I want to share with you is just sharing with you, this is a simple reminder. First Trust says, stocks won, with an exclamation point. It's just a simple reminder that, hey, you know what? Stocks, even through all the chaos that happens in the decades, in the years, stocks, which are equities, think of ETFs, mutual funds, individual stocks, they continue to give returns for investors. And so it just compares stocks versus gold, 10-year treasury bonds, and let's just start with those three. Stocks on average, since 2000, and it looks here at this chart, since September of 07, stocks have averaged 9.3% return per year. Gold has averaged 7.3% per year. And the 10-year treasury has averaged 4.9% per year. So it just shares with you. Stocks have continued to be the top performer for investors out there. It's always important just to have some portion of your investments in equities, in stocks, if it makes sense for you and if it makes sense for your portfolio. And then another page here is the history of the U.S. bear and bull markets. Simply put, let me share with you what a bull and a bear market is. A bull market is from the lowest close reached after the market has fallen 20% or more to the next market high. Typically, we like bull markets. As investors, that means the market continues to move higher from where it was the lows. So a bull market typically means that, hey, returns are positive, markets continue to move forward. A bear market is when the index closes at least 20% down from its previous high through the lowest close reached after it has fallen 20% or more. So bear markets are typically what we saw last year in March and April. Markets move downwards. They start going down more. As investors, we typically don't like that, but that's what a bear market is. And it just shares with you that, hey, the average bull market, it lasts about 4.4 years with an average total return of 152% and change. So when markets do well, they last typically for about 4.4 years, and the average total return is 152%. So again, this is since 1942. As investors, it's important to remember that if we can, stay invested because it typically does reward you. Now, a bear market, this is the time that as investors we probably don't like to see, but the average bear market lasts about 11.3 months with an average cumulative loss of negative 32%. So let that sink in for a second. Bull markets last about 4.4 years, average cumulative total return 152%. Bear markets last less than a year, 11 months and change, with an average cumulative loss of 32%. So bear markets, as much as the news, as much as the media likes to build these up and scare folks, because that's what I feel they do, when you look at the data, yes, we don't like to see a negative number, but they don't last as long. 11 months. Right now, we were in a bull market from 2008 all the way to last year. That lasted 11 years. We entered a bear market last year for 1.1 months. We were down just about 34%. We are now in a new bull market, which has lasted just about 9 months so far. So let that sink in. We're now in a new bull market. Hopefully, hey, it has some power, it has some luster, and we can continue to move forward here with this new bull market. So I want to share all of that with you. If you have any questions, if you have any thoughts, please feel free to reach out. I just wanted to share that with you, some of those visuals from First Trust Portfolios. Thank you for watching. Thank you for listening. I look forward to talking to you soon. Have a great day. Stay safe. Take care. Bye-bye.